The latest employment data from the U.S. has sparked significant concern and debate about the health of the economy. In June, the economy added 206,000 jobs, surpassing expectations. Yet the unemployment rate unexpectedly rose to 4.1%, the highest since November 2021. This paradoxical situation, combined with revisions that show lower job growth in previous months, has cast a shadow over the labor market's recent resilience. As the Federal Reserve weighs these developments, questions arise about the future of interest rates and economic stability. What does this shift mean for the broader economy, and how should policymakers and investors respond? U.S. economy adds 206,000 jobs, but unemployment rises. The latest figures from the U.S. labor market reveal a complex and somewhat troubling picture. In June, the economy added 206,000 jobs, exceeding the expectations of economists who had predicted 190,000 new positions. However, this positive headline figure is overshadowed by an increase in the unemployment rate, which climbed to 4.1% from 4%, the highest level seen since November 2021. Labor market cooling down. The Bureau of Labor Statistics, BLS, reported not only the new job additions, but also revised down the job growth figures for April and May. These revisions showed that the job gains for those 2 months were 111,000 lower than initially reported, indicating a slower pace of growth than previously understood. This cooling in the labor market is significant, as it suggests that the economy might not be as robust as it appeared just a few months ago. Federal Reserve's cautious approach. The strength of the labor market over the past 2 years has allowed the Federal Reserve to take a cautious approach to lowering borrowing costs. As inflationary pressures have eased, the central bank has closely monitored employment conditions to decide when to commence an interest rate cutting cycle. The recently released minutes from the Fed's June meeting revealed that policymakers are increasingly attentive to the downside risks to the labor market. They noted that with the labor market normalizing, any further weakening of demand could result in a larger increase in unemployment than seen in the recent past. Signs of softening. Several factors are contributing to the softening trend in the job market. Robert Tipp, head of global bonds and chief investment strategist at PGIM Fixed Income, noted that despite what initially appeared to be a boring report, various elements are pointing to moderation. These include downward revisions to previous months' job numbers, a high proportion of healthcare and government jobs in the recent figures, cuts to temporary workers, and a weak household survey. Impact on wages and employment trends. Average hourly earnings rose by 3.9% from a year ago, in June, marking the slowest pace of growth in 3 years. This slowdown in wage growth is another sign of the cooling labor market. Data from earlier in the week provided a mixed picture. Private employers added fewer jobs than forecasted in June, and new weekly applications for unemployment aid ticked higher. However, there was a slight increase in the demand for workers in May, as evidenced by a better-than-expected job openings report. Market reactions and economic outlook. The release of June's softer payrolls data led to a drop in Treasury yields to their lowest levels in several months. Traders are now betting that the Fed could cut interest rates twice this year, with the first cut potentially coming in September or November. The yield on the 2-year Treasury, which is particularly sensitive to monetary policy expectations, briefly dipped below 4.6% for the first time since early April. This represents a significant drop from Wednesday's level before the public holiday. On the stock market, the S&P 500 advanced by 0.5%, marking its third consecutive record high close. Gains in heavyweight technology stocks countered declines in more than half of the index, indicating mixed investor sentiment. Uncertain economic future. Eric Winograd, a senior economist for fixed income at AllianceBernstein, expressed that while the latest jobs report was weaker than expected due to downward revisions, it does not fundamentally alter the picture of the domestic economy. According to Winograd, the labor market is not falling off a cliff, but the slowing pace of job growth and rising unemployment rate suggests that the economic outlook is becoming more uncertain. Conclusion: the current state of the U.S. labor market presents a paradox. Job creation continues, yet unemployment is rising and wage growth is slowing. This complex scenario raises important questions about the future direction of the economy and the appropriate response from policymakers. As the Federal Reserve deliberates on its next moves, the broader implications for economic stability remain to be seen. What are your thoughts on the recent labor market trends? How should the Federal Reserve respond to these mixed signals? Share your opinions and join the conversation.